Good morning, everyone, and welcome to Show Me the Money. My name is Deirdre Shaw, and I am the CRA specialist for the City of St. Cloud. We have a great presentation for you here today. We're going to help you find money and financing for your small business. Today, Mr. Lonnie Koyama from the Small Business Association has a presentation prepared for you. And at the end, I will talk to you about a few grants that the City of St. Cloud and St. Cloud CRA has for your small business. If you have any questions, please put it in the chat box and we will address them at the end of today's presentation. Please enjoy.
Thank you, Deirdre. Hello, folks. Lonnie Koyama from the South Florida District Office of the Small Business Administration, also known as the SBA. Let me tell you a little bit about the SBA before I get into this presentation. The SBA is a federal agency, one of the smaller federal agencies, but our role is to help small businesses. And we have several different programs for that. One is, you may have heard of SBA loans. I'm going to get into that in a lot more detail during this presentation. We're also very involved with federal government contracting. It's the role of my agency, the SBA, to monitor all federal contracts and ensure as many as possible go to small businesses. Another thing we're involved with is counseling. So there are several entities that we sponsor that do counseling at no cost to you. One of them is the Small Business Development Center, also known as the SBDC network in Central Florida. They're co-sponsored by the University of Central Florida. And so they have offices throughout Central Florida, Orlando, Kissimmee. There's also an entity called SCORE. SCORE is a group of volunteer mentors who help coach you on starting and growing your business. And then there are women business centers. There's one in Tampa, there's one in Melbourne, and there's one down in Palm Beach. But they too, they get half their funding from the SBA. The other half of their funding comes from their host organization. Another thing we're very involved with is disaster assistance. Anytime there's a physical disaster like a hurricane, tornadoes, flooding, then the SBA usually sets up offices within days after the physical disaster happens to help not only businesses, but also homeowners, renters, and different people who have been affected by those disasters. So let's get into this presentation, financing options for your small business. So a couple of years ago, while working for the SBA, I found that most of our presentations had just to do with conventional bank loans or SBA guaranteed loans, and they really didn't talk about other forms of financing. So the purpose of this presentation is to talk about the other forms of financing that are out there. Some are good, some of them are things I would never do personally, but the whole point is just to educate you and let you know about all these different forms of financing. So one of the things I get called on about all the time is grants. And for the most part, there aren't many grants from the federal government. As it says in the middle of the slide there, federal government does not provide grants for starting a business, paying off business or personal debts, covering business operating expenses. However, there are some grants out there. At the very beginning, Deirdre talked about a grant from the City of St. Cloud that is available. So she could share that information with you. There are still some other grants out there. For example, if you're in a rural area or if you're in agriculture, I think the Department of Agriculture has some grants available. Another grant that's out there is through the Small Business Innovation Research Program, SBIR. This is particularly for companies that do research and development, R&D. So as it says in the middle of the slide there, SBIR grants can generally be used only to fund the R&D efforts of qualified businesses to help them develop and market innovative technological products. Let me give you an example. So Uncle Sam has different needs, and sometimes there isn't a product or service out there that can fulfill that need. So what they do is they advertise grants that can, they're looking for solutions to problems. And most of the grants come from the Department of Defense, but there's also some from Health and Human Services and other federal agencies. Let me just give you one example. There was one, this was a couple of years ago, this was from the Marine Corps. They were looking for a portable water filtration system. And as you know, the Marine Corps goes into battle areas, and sometimes there's no water there, or sometimes the only water there is maybe a river, a lake, a pond, something like that. And so typically you can't drink that water without getting violently ill. So what they were looking for was someone who could create a portable water filtration system so that you could use it on these other sources of water. So what they do is they put out a request for proposal, and in the request for proposal, they describe what the problem is, and then they ask for small businesses to submit proposals on, hey, how would you fix this particular problem? And they're looking for companies to submit their proposals. They go through the proposals and they figure out, okay, which one of these looks like it has the best chance of actually succeeding. So then they pick that one, and then they're given a grant. So you're given a grant to build a prototype of this solution. And then if you're successful with the prototype, then you can apply for a secondary grant to actually commercialize that prototype that you created. There's some really good things in this related for the small business. One is that if you come up with any proprietary things like patents, you get to keep the patents. Uncle Sam doesn't take them from you. The other thing is that you already have a customer. Uncle Sam has already told you, we'll buy this. If you could create a solution, we will buy the solution. So you already have a solution, a customer for the problem, for your solution. So it's a great program, particularly for those companies that do research and development. Here's another something else for companies that do research and development. It's from the National Science Foundation. It's called America's Seed Fund. And it's comparable to what to the prior program I was just talking about. I got a call about a month ago from a guy who had some patents, and he wanted to get some money to build on his patents and to actually turn them into working products. So through the National Science Foundation, you can apply for grants to actually make that happen. As it says there in the middle of the slide, each year we award $200 million plus in research and development funding to about 400 startups across the United States. So these are two different programs, both for companies that do R&D. Okay, let's talk about just some financing terms, just so you have a good understanding of what they are. So there's debt financing and there's equity financing. So debt financing is when you're borrowing money. Equity financing comes from selling stock in your company. So going to the slide, debt financing, money is usually from a loan. There will be payments and interest expense. The lender has no direct claim on future profits. So that's one of the advantages to debt financing, is that if you hit a home run and your company becomes worth $1 billion, then whoever lent you that money doesn't have any claim to whatever happens to your company, because you already had the terms of the loan set up and you're just going to pay off based on the terms of the loan. So that's one of the advantages. One of the disadvantages to debt financing is you have that monthly payment. I mean, typically it's monthly, but you have that monthly payment that you have to make no matter what. You have to pay off that debt. At the bottom, equity financing, money usually comes from the sale of stock. So that's usually when you incorporate your company and then you sell off a piece of the company as a way to generate funds. You could do this when you first start your company, or you can do it later on when you maybe you want to build a second facility or a second store or a second manufacturing plant, and you need money for that. So then you can sell stock in your company as a way to generate revenue. Owner's equity is diluted. That's one of the downsides. So that if your company takes off, if you end up being worth $1 billion, then you sold off shares in your company. So whoever bought those shares is taking that stake in the company with them. And you may regret having sold off a piece of the company. It just depends on your situation. One of the advantages on the bottom, no interest expense to be paid. So you don't have to worry about making that monthly payment to pay it off, because it's not a loan. You sold off stock as a way to get money. All right. There are two kinds of loans. One is a secured loan, and then there's unsecured loan. So with secured debt, secured financing is backed up by collateral, personal or business assets such as investments, real estate, vehicles, or equipment. Because these can be difficult for the lender to turn into cash, good credit is still important. Unsecured debt. Since unsecured financing requires no collateral, obtaining it depends largely on your personal and your business credit profiles. You will need strong cash flow to show the ability to repay what you borrow. Unsecured financing tends to provide smaller amounts. Oftentimes, you're going to pay a higher interest rate on unsecured debt too. So let's talk about conventional bank loans. This is probably the cheapest money there is. Sometimes it's the hardest money to get. So going to the slide, the pros, they often have the lowest interest rates. Cons, sometimes the hardest money to get. Questions that are going to come from the banker. How much money do you need? Accuracy is important, so request enough money to invest wisely. But you don't want to be vague about how much money you need, which goes to the second question. What are you going to do with the money? You will have to provide in detail the designated use of every dollar requested. So you want to be very specific. When will you repay the small business loan? You will need to convince the lender that you're able to repay the loan. So they're going to want to look at your either your current cash flow if you're an existing business, or your projected cash flow if you're a startup company. Typical requirements for conventional bank loans: a detailed business plan, personal business credit history. Well, let's go back to the detailed business plan for just a minute. So earlier I talked to you about some of the entities that are out there that the SBA sponsors that can help you, such as small business development centers, SCORE, women business centers. They can all help you create a business plan. They won't write it for you, but they can help coach you on making a good business plan, one that's presentable to a bank. So you'll have to write it up yourself, but they can coach you on what needs to be beefed up, what needs more detailed, just basically just coaching you so that you have a really good business plan. Other typical requirements: personal and business credit history. So if you're a startup, you're not going to have any business credit history. So your personal credit history is really important. That factors into so many things having to do with borrow money. So it's really important that you get your credit straightened out now instead of waiting until you actually need the money, because it usually takes a while. It takes anywhere from several months to several years, depending on what your credit history looks like. But you have to be credit worthy. No one's going to loan money to somebody with bad credit or somebody who shows that they're not going to pay off their debts. All underwriting decisions are affected by your personal credit report and your credit score. Personal and business financial statements. So these are all projections for a startup. Cash flow projections. Approach banks or lending institutions you have worked with or are a customer of. So if you already have an account with somebody, that should be the first bank that you approach about getting a loan. Talk to a lending officer, find out exactly what documentation they require. It doesn't hurt for you to schedule an appointment or just to walk in and talk to the lending officer about small business loans, how much they lend, just different information that they're going to require. Try to develop a rapport with that individual because it may pay off a couple of months down the road. When it comes time to get a loan, be thorough, bring everything they ask. So that's a conventional loan. The SBA, let me talk about the SBA loan guarantee program. So there are 10 different loan programs, one micro loan program. The SBA guarantee is up to $5 million, and it's for both startups and existing businesses. Our most common program is called 7A. That loan guarantee is up to 75% for loans greater than $150,000. One of the advantages to the SBA guaranteed loan is the terms of the loan. Typically, it's going to be a longer term loan. For fixed assets, such as buying a big piece of equipment or a property or a building, the terms can be up to 25 years. So the advantage for that is it makes it really easy to make the payment, and it won't affect you from a cash flow perspective. It'll still affect you, but not as much as if you had, for example, a 5-year loan, and then you had that massive monthly payment. Working capital loans up to 10 years. So working capital are typical month-to-month business expenses. Interest rates on 7A loans are prime plus 2.25. So last time I checked, prime was 3.25. So the interest rate would be 6.5%. It can be accessed at any participating bank. One of the good things is that just about every bank in the state of Florida has SBA guaranteed loans these days. Last year, just in South Florida alone, we did $2.25 billion in SBA guaranteed loans. There are also lines of credit that you could get. They're SBA guaranteed, but they're lines of credit instead of a loan. So some of the pros is that you only pay interest on the amount that you borrowed. You only borrow only when you need it. Ideally, a line of credit is the perfect way to get money. That way, you're not borrowing more than you need, and you're only paying on what you actually owe. Using a line of credit allows you to build a positive business credit history as you use the line and make the payments on time. Cons typically requires upfront fees to obtain the line. Even if your business fails, a line of credit is a business obligation that has to be repaid. And that's true for any loan, really, because on just about any loan, you're going to have to sign a personal guarantee. It's pretty rare that you wouldn't have to sign a personal guarantee. Another common loan that we do is called a 504 fixed asset loan. So these are long-term fixed rate financing, typically 10 to 20-year terms. There's a split. So there are two lenders. There's a bank, there's a certified development company, and then there's you, the borrower. One of the great things about these is that in many cases, you can get in on one of these loans with only 10% down, as opposed to 20% or more for other types of financing. This is only for fixed assets, such as commercial real estate, buying a building, or buying machinery, such as a big piece of equipment that is not going to pay off immediately. I was talking to a guy this morning who was looking for a 504 loan for his company. He was looking to buy 3 or 4 large trucks and in one shot. So that was going to require a big loan, and it's going to take a while for that thing to pay off. So a 504 loan would be ideal in his situation. And then, as I mentioned earlier, there's a lower equity requirement. So that's how much you have to put down yourself, as low as 10%. So the SBA loan guarantee, how does it work? Step 1, work with your SBA and our resource partners to develop a finalized business plan. Step 2, visit your bank or lending institution to discuss financing options. Step 3, the lender decides whether to work with you on a traditional loan or seek an SBA guarantee. So they're really going to look at your financial situation to see whether you qualify for a conventional loan or an SBA guaranteed loan. It's really going to be the banker's decision on which route to go. At the bottom, Lender Match is a tool that the SBA put out a couple of years ago. It's a way to quickly find a lender for an SBA guaranteed loan. So if you go to that website, it will ask you for information about your company, your industry, your revenues for the last couple of years, your profitability. And basically, it farms that information out to banks that are in your community. And so hopefully, all the banks take a look at it, and hopefully you'll get a call from 2 or 3 of them who may be interested in doing a loan with you. Could be that nobody gives you a call. And usually that would happen because there's something about your company that doesn't look enticing to them. Maybe it could be your industry, or it could be your credit history, who knows. But so there's no guarantee you're going to get a call using Lender Match. Another program we have out there is through micro lenders. So as it says there, they're typically nonprofits, they're community-based, they lend to entrepreneurs and existing small businesses. They also typically provide educational resource, business guidance, coaching, and mentoring. So a lot of times they're also going to want to coach you to make sure 2 things, to make sure, 1, that you're successful, and number 2, to make sure they get paid back. So the micro lenders do loans between $500 and $50,000. So, they're lower loan amounts, but oftentimes you don't need more than $50K to get started. The SBA makes direct loans to the micro lenders who use that money to make the loans to eligible small business borrowers. And there's a list through that link there to get to micro lenders. I'm going to be sharing a PDF copy of this with Deidre, and so she can share it with you. There's also another entity out there called Community Development Financial Institutions. As it says on the bottom of the slide, there are 36 CDFIs in Florida. They're specialized community-based financial institutions with a primary mission to promote economic development. So they're usually in smaller areas, and they usually only take care of people in their area. But if you're in their area, it could be an excellent source of a low-interest loan. They're typically not going to be high dollars, but again, maybe you don't need a whole lot of money, but it could be a good source of finding some money. All right. So earlier I told you that I'm going to be covering a lot of different types of borrowing or different ways to get money. And some of them are good, some of them not so good. So this one falls into the not so good. However, there are a lot of people, a lot of entrepreneurs that use hard money loans that are successful, and they use them. So these are typically short-term loans. It's a loan of last resort or a short-term bridge loan. So you're not going to get it through a bank. It's a bridge loan means it's something where I just need money for a short term. Lenders offer loans the banks can't, primarily used in real estate transactions such as house flipping. So you know, if you're someone who wants to flip houses, the bank is never going to finance that. Most lending institutions are never going to finance house flipping. However, hard money lenders will finance house flipping. They move quickly and lend mostly on collateral instead of on credit scores. So usually what's happening is if it's a house flipping, for example, they'll probably use the house that's being flipped. That'll be the collateral for the loan. So that if you don't pay them off, they're going to take over that property, and they're going to be the ones who profit from that instead of you. Lenders are often private individuals or companies that see value in this type of potentially risky venture. The cost of the loan to the borrower is typically higher, reflecting the higher risk that the lender is taking by offering the financing. So it's typically going to be a higher interest loan over shorter terms. Online lending. This is probably the fastest growing type of lending that's out there. Not the same as crowdfunding. I'm going to talk about crowdfunding later. Most are unsecured personal loans, so there's no collateral involved. Some let you compare several loan offers all at once from different lenders. The interest rates are typically higher than you would pay using a conventional loan. Read the fine print. So it's very important that you really understand what it is that you're doing so that you don't pay some crazy rates, which I have seen from a lot of online lenders, such as well over 20–25% interest. Because many of these services are automated, they sometimes offer faster service. And that's one of the reasons I think this has become so popular is, you know, you go register your company with the Secretary of State, and then all of a sudden, you know, they have your email, these online lenders have your email address, and they start sending you emails about, hey, I want to get money quickly. And, you know, it looks real easy. You don't have to go talk to a banker. You could do this all from sitting in front of your computer in your pajamas. So it's relatively easy, but it can be very expensive and very painful. So I highly encourage you to read the fine print. Sometimes they also have penalties for prepayment, which is not something you never should have to do. So be careful. Commercial real estate financing. So this is comparable to a home equity loan. So if you have some commercial real estate that you own and you have equity in it, this is it's like a home equity loan, only you're using commercial real estate as the equity to get the loan. So in this case, you get loans of $75,000 up to $20 million, get up to 55% loan to value for refinancing of your commercial real estate. You can get 20 to 30-year loans with rates of 48% if your FICO score is 650 or higher. And sometimes there's some SBA 504 loans that are comparable to that. Another way to get funding is from friends and family. This is one of the most common ways to get money, is through friends and family. So, some rules related to this. Don't be afraid to ask. Practice your elevator pitch, and end by asking for the order. You need to convince them that you have been working on this vision for a long time and have done your due diligence. So if you're going to go talk to your wealthy Aunt Edna about this, you need to be able to show that this isn't something that you dreamed up yesterday, that you've been working on this for a while. Demonstrate your progress and your own skin in the game. By skin in the game, you need to be able to show that you've invested some of your own money. Saying that you need money to start is not nearly as convincing as saying you have built a prototype on your own dime, but you need more to roll it out. Ask for the minimum rather than the maximum. Again, we're talking about friends and family here. We're not talking about a bank. Communicate the risks and write down the agreement. Be honest with naive family members and friends about the inherent risks of a startup. So a couple of points here. Let's say you go talk to your wealthy Aunt Edna and about getting some money for your company, and you don't really discuss whether it's a loan. You're just asking her for $10,000. And let's say she writes you a check for $10,000, but you don't have any kind of agreement in place. And let's say, unfortunately, Aunt Edna dies 2 weeks later. So you go on, you form your company, you do fantastic, your company's doing great. All of Aunt Edna's kids, your cousins, they all know that she gave you that $10,000. And to them, Aunt Edna owns half of your company. That was their understanding, is that was an investment. It wasn't a loan, it was an investment. And there is no agreement. So they think they own half of your company. So later on down the road, when you're doing, your company's worth $1 billion, you don't want to pay them, or you only want to pay them back the 10,000. They may want to take you to court and sue that, hey, they actually own half your company. And since there wasn't an agreement, then you actually put yourself in a bad situation. So I highly encourage you to write down an agreement. If you get money from family or friends, if it's a loan, write down, this is a loan agreement, the terms of the loan, the monthly payment, the interest rate, all of that good stuff. Both parties sign the thing so that it's very clear about what this is. Is this a gift? Is this a loan? Is this an equity financing where they sold off shares and she invested and she owns 25% of the company, 10%, 50%, whatever the agreement is, write it down. At the bottom, don't take money from family or friends who can't afford to lose it. I've seen a couple of instances, including this one. If you go to YouTube, there was a show that was out there for a short period of time called Billionaire Buyer. And one of the episodes, and actually it was episode number 1, there was a situation where these two kids borrowed their parents' retirement account to start a business. And they were spending the money like crazy. Actually, I got very upset watching this. It really made me angry that the kids would be so nonchalant about spending their parents' retirement funds like that. And just very disrespectful. And, it made me angry at the parents for ever having lent them the money. They should have never done it. They put themselves in a bad situation. So don't let that happen. Self-financing. This is the most common type of financing there is. So one of the things you do need to be aware of, though, is your personal finances will affect your business finances. So it's really important that you have a budgets for both yourself on the personal side and for the business, and have enough money set aside to take care of both yourself personally and the business until you become profitable. Starting a business can be a tremendous strain on your personal finances. So one of the big mistakes people make is they start pulling money out of their business too soon, and it ends up crippling their business. And in many cases, the business goes under because they didn't have enough money set aside to carry them through the startup period. It takes time before your new venture turns a profit and provides financial support. Before starting a business, get your finances in order. So pay off any debts that you can. Get rid of any excessive payments or anything, any expenses that you don't really need. Tighten up your budget. Writing monthly household budget, so that's on the personal side. And then do check your personal credit history. That's something you should probably do today. Lenders and suppliers will use your personal credit history to determine your terms of credit. Get a copy of your personal credit report from one of the 3 major credit bureaus. Actually, you should get one from all 3 of them. It's free. If you go to that link, annualcreditreport.com, you can get a free credit report every year from each of the 3 agencies. And the thing to look for is, is there any dirt that's in that credit report? There may or may not be, but it could be that there's some stuff in there that's not right, that maybe somebody reported something incorrectly, so you want to get that cleaned up now. Don't wait until you apply for credit to find out that you have a bad credit report. Check that out now. Keep your day job. If you already have a job, don't quit it too quickly. Work on your business as much as you can when you're off work. Save money and consider you're starting your business small. I encourage people to start from home if you can. Don't go rent or lease a business property, especially if you don't have to in the beginning. If you can work from your own home, that's going to have a huge impact on whether you're profitable or not. So do as much as you can from your home while you can. Selling shares and equity. I talked a little bit about this earlier. We're talking about selling shares to your company. So you're going to need to incorporate to sell shares. So you're going to be a corporation, and there are different types of corporations out there. There are C Corps, S Corps. Shares represent ownership rights to a company. You can sell shares of your company either to raise capital in the beginning or to sell your business outright. Either to raise capital, so you can use it in the beginning, and after you've been around for a couple of years, you want to raise capital to maybe start up another location, or you can sell shares to sell your business outright. Prepare a valuation report on your business. This often requires the work of a specialized accountant. So a valuation report is something where an accountant takes a look at your books to determine how much the business is worth. And it's based on a lot of different factors. It's based on the industry that you're in. It depends on how you run your company, because certain companies are worth more. Companies that can be managed where you can sell it without you having to be there are actually worth more. There are some companies out there where if the owner was to walk away, then the company has no value at all. So those are the companies where the owner is just an integral part of the company. And without that owner, then the business falls apart. So those companies don't have the same value as one that, something that you could probably maybe franchise, something that you could duplicate, something that where I can bring in a manager to run this thing and I don't have to be here every day. Those are worth more money, particularly if they're profitable. Approach potential investors you have identified and sell the shares to the highest bidder. Do not sell your shares below what you estimated they're worth when you conducted an evaluation of your company. Initial public offering, also known as an IPO. This is when a company's first sale of stock to the public, where its stock is then traded on one of the major stock exchanges. So it could also sell shares on the penny stock market. This is complicated, expensive, requires a strong operating history, can be the holy grail to catapult the founders to riches. See eBay, Amazon, Cisco, Google, Whole Foods, Facebook, Starbucks. In each of the cases of the companies at the bottom, they all, before they sold stock, they all had a really strong plan for growing the business, becoming very profitable, and the investors all knew what was going to happen, so people were willing to invest and buy shares in the company early, even though none of these companies was profitable in the beginning. But down the road, they all become very profitable, and when they did the initial public offering, now they're all worth billions of dollars. Partnerships. So anytime you're considering having someone own the company along with you, whether it's as a corporation with shares or as a partnership, it's very important that you do a couple of things. One, keep in mind that the partnership is like a business marriage. The startup costs compared to corporations, startup costs are low and primarily involve paying to file registration paperwork with state governments. Pooled resources may be helpful when it comes to pooling resources to secure credit and raise capital for the company. Partners can also complement each other's skill sets. So maybe you have two partners who are looking to open a restaurant. Maybe one of them used to be a chef somewhere, so they have a really good understanding of the kitchen operations. And maybe the other one used to be a bartender or their manager of a restaurant, so they have a good understanding of the front end of a store. So that might be a good partnership or arrangement in that situation. Limited partners have no desire, so there are limited partners and general partners. Limited partners have no desire to be involved in the management decisions of the company. They enjoy limited liability for the debts and obligations of the limited partnership. They are only liable for the extent of their investment in the limited partnership. General partners are more involved in the management decisions of the company and have liability for the debts and obligations of the business. So limited partners typically are hands-off. General partners typically are very hands-on. Profit sharing. The operating agreement outlines profit and loss sharing among partners. Limited partners only receive a share of the profits, and the percentage of that share is based on the allocation outlined in the operating agreement. So that operating agreement is really important. This next paragraph is probably the most important thing I'm going to say today, particularly for those of you who are going to have more than one owner. Disagreements between all partners may occur that require arbitration or judgment by a court. This can be time-consuming and costly and can interfere with the success of the business. An operating agreement, bylaws, shareholder agreements, and buy-sell agreements can resolve many issues before they come up. So regardless of how you set yourself up, if you're going to have partners or joint ownership, I highly encourage you, depending on how you're set up, to either have the shareholder agreements, buy-sell agreements for any of the most common things that can happen in your business. Let me give you a real life example. Back in about 2007, there were two women who had been best friends since they were little kids, and they wanted to open this consignment store together. They had talked about it for years and years, and they were finally getting into it. So they finally opened up. They opened up in 2008, and as you may remember, what happened in 2008, well, that was the Great Recession. That was the start of the Great Recession. That's when the real estate market crashed. And so it was probably the worst time to open a business, maybe even worse than COVID. I don't know, depending on the nature of your business. In any case, they opened up this business and things didn't do well at all. We were in a recession. It was just a matter of time before one of the partners wanted to sell out, but the other one didn't. And so they ended up fighting about it and going to court. So here are two women who were the best of friends all of their lives, and all of a sudden they're suing each other. So it's just like a marriage, as I said earlier, and it's just like a divorce. Who wins in a divorce? The lawyers. No one else wins in a divorce but the lawyers. So that's why these agreements are so important. And so I highly encourage you to address some of the most common things that can happen, such as one of us wants to, if one of us wants to sell out, what are we going to do? What are the rules for how we're going to handle that? You know, does the other owner have a right of first refusal? How are we going to determine the value of the company? Because that's really important, the valuation. What happens if one of us dies? How is that going to happen? You know, it could be that one of us dies and, you know, I don't get along with my partner's spouse at all, and I know this isn't going to work. So you need to have agreements in place for those most common issues. Moving on, venture capital. So you've all seen Shark Tank. Shark Tank is not, it's not, I don't know. There are many things about Shark Tank that are not realistic. typically, if you're going to make a pitch to a venture capitalist, so venture capitalists are wealthy, either wealthy individuals or groups of individuals or a fund, sometimes a group of investors that pool their money and they want to invest in small businesses. So typically it's going to be an equity investment, meaning they want a stake in the company, they want shares in the company. This isn't a loan. Sometimes it's a combination of an equity investment and a loan, but it's always going to be an equity investment. They're always going to want a stake in your company. Typically, the companies they're looking at are high tech, not always, but they're always seeking high earnings growth. So they're looking for companies that can show great profitability or the home run. So they're looking at companies with the potential for great for expansion or great profitability, or maybe you have some proprietary information or patents that can be very valuable. It's an active rather than a passive form of financing. So they want to be very involved in running your company. They want to make sure that their investment pays off. So they're not going to just invest $250,000 and hope that you get there. They want to be involved and make sure that you're going to get there. So there are different ways they can do that. Sometimes an investor is given a board seat or management influence. In some cases, they're actually one of them or somebody affiliated with them is going to take over as a CEO. So I don't know how you'd feel about that. But then again, if they know how to grow the company and take it to the higher level, it could be that that's the right thing to do. You need to look at it yourself. Only 1 out of 100 applicants may get funded. So that means of all the people that go and do pitches in front of these people, only 1 out of 100 may get funded. So usually what happens, it's not just one pitch like it is on Shark Tank. It's usually a series of pitches, and you need to pass each one to get to the get funded level. Florida-based companies raised approximately $2.9 billion from 261 venture capital deals in 2019. In 2018, Florida companies closed 276 deals worth $1.8 billion. So as you can see, it's a growing. I don't have newer numbers than that, but I know it continues to grow. And so the number of venture capitalists out there continue to grow too. So there's that link at the bottom is where to find some venture capital companies. Crowdfunding. So crowdfunding is a relatively new phenomenon. It's probably been around about 10 years. How does it work? Entrepreneurs use the internet to help talk to thousands, if not millions, of potential funders that each contribute a small amount. The entrepreneurs must create a promotion and or buzz to get people to want to contribute. Investments or donations are made through online platforms which then coordinate and administer the fundraising. So here's an example. This is one from a couple of years ago where this old guy was pushing this popsicle cart down the street in Chicago. And this guy saw him and he went up to talk to him. He said, "Oh man, you should be home retired. Why are you pushing this cart around?" He said, "I was home retired, but my daughter, who is the breadwinner in our family, died, and now we need to have money to put food on the table. So I'm doing this." So the guy took a picture of him and he went back to his office and he told another buddy in his office, what he saw, and he gave him the story. So the first thing that happened is they put it out on Facebook and this story went viral. I mean, as you know, viral means that the story just grows like gang fire and it spreads across the country, sometimes worldwide within days. And that's what happens with this story. The other thing that happened though is his buddy said, "Hey, we should set up a crowdfunding campaign to help this guy." And that's exactly what they did. And as it says on the top of the slide there, crowdfunding raises more than $400,000 for an elderly, they call them ice block vendor, but it's really a popsicle vendor. So there are different types of crowdfunding. There's donation-based crowdfunding. That's what this last that slide was. That was donation-based crowdfunding, asking the crowd to donate to your project in exchange for recognition, appreciation, or items of value. Donation-based is used by nonprofits, creative artists, developers, filmmakers, writers, and inventors. There are different websites depending on what the type of crowdfunding you're doing. There's reward-based crowdfunding. In return for a monetary offering, the the crowd receives an item or a service. This can be considered a form of pre-sale and merchandising. Reward basis for a person or company with a product beyond ideation that can be produced for a determined amount of money in a reasonable period of time. This is a story I saw recently. Miami-based LIV Swiss Watches sells limited edition Swiss-made watches direct to consumers at discounted prices. They finance the production of their custom watch models using the Kickstarter crowdfunding platform. Investors essentially pre-order a watch by backing a new model, which can run from $390 to about $1,200. This is brilliant on the part of this company, LIV Swiss Watches. So instead of having to front the money themselves and pay for inventory and manufacturing, they get the companies, they get their customers to prepay on the watches, and then they have the money to pay for the watches, and it's a brilliant form of financing your company. There's also equity-based financing. So this is a way to sell stock on the internet. There's some limitations on how much you could sell, but it's a way to sell stock without going through a New York Stock Exchange or one of the or doing an IPO. Debt-based crowdfunding, also known as peer-to-peer lending. This is where you, let's say you got $10,000 from your Aunt Edna when she died, and it was part of her will. She gave you $10,000. So now you want to use the $10,000. You don't want to put it in the bank because the bank doesn't pay any interest. So you're looking at what can I do with this $10,000? How can I make money off of this? So what you can do is you can lend it out to small businesses through peer-to-peer lending platforms. So businesses basically make pitches on these lending platforms or websites, and they ask for different amounts of money. It talks about what the interest rates are willing to pay, talks about their credit and their credit rating, so that you have a good understanding of the risk involved. Should I lend this person money? And they also talk about what they're going to do with the money. So it's up to you, as now you're an investor and you get to decide who to lend money to. It's also a place to borrow money. So it's something that you might want to take a look at. It's a very interesting concept. So that's it. As it says here, this presentation is intended to inform and educate potential borrowers. It is not an endorsement of sources of capital outside of the U.S. Small Business Administration loan guarantee programs. So what I wanted to do, again, the purpose was just to educate you about different ways to find money out there. So right now we have a few minutes left to answer any questions you might have. I hope I can answer your questions. There's my phone number and email address if you have other questions, so feel free to write that down. So Deirdre, I'm going to turn it back over to you. And I don't know how you want to handle the questions.
Good morning, everyone. We have one question so far that was submitted. And the question is, what if your credit has recently suffered due to all the COVID layoffs? How do you prove your credit worthiness based on the company's profitability?
More than anything, it's based on your own personal credit worthiness. So your personal credit score is huge. It's a huge factor. So that's the primary thing you need to fix. And then even as far as that goes, the biggest factor in that is, do you pay your bills or do you pay your bills on time? Not paying bills will kill your credit faster than anything else. It will impact you faster than anything else. So all you can really do is start building it back up again. You can do some research on Google and on YouTube about how to rebuild your credit or what you can do to build your credit. Hopefully that answers your question.
Do we have anyone? Sorry?
Okay, I'm sorry.
Does anybody else have any questions? If not, I will briefly touch on some of what Lonnie spoke about in the beginning of the seminar, and that is about how to get money that you do not have to repay. And those are called grants. So the federal government does not necessarily have grants for small business unless you are in technology or agriculture. But some of the municipalities do have some funds. And if you're on this call, you're in luck because the St. Cloud CRA has some money for you if you qualify. So I will briefly touch on the grant programs, and in the chat box, I am putting a link to where you can find our grants. So for small business grants, we have our special events grant, and that is if you want to put together an event downtown, if you want to put together an event in the CRA, what we do is that we give you $1,000 that goes towards your marketing, and it goes towards helping you put on an event downtown. Also, we have our business tax receipt grant program. To operate within the city of St. Cloud, you have to have a business tax receipt. We will do a reimbursement up to $100 for the cost incurred of the business tax receipt. We also have the Business and Site Improvement Grant, which is our BSIG program, and that is an external facade program that is used to help you spruce up the outside of your building. If you are not an owner of the building, you get the permission from the owner of your building. We have the application, see if you fill out some qualifications, and you can get up to $65,000, and there are special there can be a waiver to get a little bit more, but that's also to help painting. It will help you with maybe outside furniture. It'll help you with a lot of the things that you need that might be an extra expense to fix up the outside of your building. And also, we have a few other grants. If you are interested in that, just contact me at CRA@stcloud.org. So that is CRA@stcloud.org. You can call me on 407-957-7235. It has been a pleasure to learn from you, Mr. Koyama, and it has been great for everybody here. I'm so glad that you were able to attend. If you have any questions, please reach out to Lonnie or to myself. And just have a great day. Enjoy your afternoon. Thank you.
Thank you, Deirdre.